With the first quarter in the books, markets experienced no shortage of pivotal events to start the year. While sentiment was positive heading into 2025, the inauguration of US President Trump on January 20th triggered a flurry of activity. A wave of executive orders and escalating tariffs took center stage in the first 3 months of this year. With plenty of important market developments to cover, let's dive in. Several trends that have been in place over the last couple of years started to reverse course. US stocks outperforming the rest of the world, no longer. Growth stocks outperforming value stocks, no longer. Interest rates moving higher, also no longer. And lastly, smaller companies outperforming larger companies, you guessed it, not anymore. Now, the directional pivot of these investment themes is noteworthy, and whether they'll continue is a healthy debate to be had. But in the meantime, the reversal has seriously created a significant risk-off environment in markets. This means lower risk investments are beginning to outperform while showing greater stability than higher risk investments. Despite economic uncertainty, negative returns across many global markets, our strategies have navigated recent volatility quite well. In the first quarter, our Series O strategies delivered the following returns. Starting with our Macro Diversified Income Fund, which was up 2.4%, Macro's Balanced Fund, which was virtually flat at up 0.1%, Macro's Global Equity Fund, which was negative 0.9%, our Canadian Equity Income Fund, negative 0.9%, and lastly, our Opportunities slipped a bit at negative 7%. So what's caused these trend reversals? Heading into the year, Jerome Powell, head of the US Federal Reserve, had a steady hand on the flight controls, guiding the US economy to a soft landing. The labor market was sturdy, inflation moderating, while nominal GDP growth and corporate profit growth expectations were all healthy. However, President Trump's administration had other plans. From their perspective, global trade imbalances unfavorable to the US economy needed to be addressed. Now, one could debate the validity of that claim. Nonetheless, this has led to a wave of newly imposed tariffs, both broad and targeted in nature. While President Trump's first administration implemented tariffs on approximately $380 billion of imports, the total under his second administration is projected to exceed $1.4 trillion. Now, the economic damage caused by tariffs will take some time to filter their way into the economy. In the meantime, policy uncertainty is nearing all-time highs, making it difficult for corporate executives to execute on their business plans. When removing some of this noise and focusing on economic fundamentals, the message being received is still one of mixed signals. Net monthly job growth continues to be positive, and weekly initial jobless claims are being held in check. However, Elon Musk's Doge department, government job cuts will begin to surface in the data throughout the second quarter. Modest layoffs in the private sector have also emerged, but overall employment remains at healthy levels. The real question going forward is whether executives will begin to tighten corporate purse strings even further, leading to a greater degree of private sector layoffs. Here in Canada, the longer the tariff battle with our neighbors to the south carries on, the more likely and the more intense the labor market damage is likely to become. Now, in light of the upcoming trade dislocations, market participants and economists have both begun to moderate their growth expectations. This is evident in both nominal GDP growth expectations as well as the estimates for anticipated corporate profit growth, which are being revised lower by a greater margin than normal. Meanwhile, Canada has been bracing for the economic pain brought on by the tariffs. The sectors in the eye of this storm are the energy, automotive, and the aluminum industries. The additional cost of the tariffs on these three sectors combined is estimated at $33.1 billion. Now, the aerospace, agriculture, and lumber industry will also find themselves leaning into these trade headwinds. On the political front, the new leader of the Liberal Party, Mark Carney, has called an election which will be held on April 28th. Their recent momentum in the polls explains the short campaign cycle of 36 days, which is consistent with the minimum campaign length mandated by the Canadian Elections Act. Now, at the beginning of the year, the Conservatives held a 24% lead in the polls. This has since evaporated, with the Liberals now polling ahead of the Conservatives at 41% versus 38%. What's clear is that the new leader will need to address the economic threat of this escalating trade war head-on and quickly. Now, while some of the US exceptionalism shine seems to be fading, across the pond over in Europe, they seem to be reaching an inflection point. Economic data is still somewhat soft, but investors seem convinced it's reaching a trough and is beginning to turn the corner, and their cheaper stock prices represent good value. When looking at global equity market performance in the first 3 months of the year, Europe's leadership and the US's trailing performance highlight the stark contrast to the past 2 years. Over the past 2 years, investing felt a bit like sailing with strong tailwinds. Healthy economics and technological advancements served as the rising tide, lifting all boats. Now, shifting winds reinforce the importance of diversifying from a regional perspective, diversifying from an industry perspective, diversifying from a company perspective, and lastly, sourcing investments at proper valuations. Listen, I'm going to sit down for this. It seems the playbook from a political perspective is to leverage uncertainty for sovereign benefit. Whether a short-term tactic or a long-term strategy, uncertainty will be a constant throughout the Trump administration's second term. As professional investors, we embrace the headwinds regardless of the direction and the power of the gust. Volatility is likely to persist, and it will create opportunities to invest in quality companies at bargain prices. If you're a Matco investment client, periods like this are precisely why you've hired us. We remove the emotion from investing while ensuring your portfolio is aligned with your risk profile. We diversify your portfolio originally, by industry, and across company exposures. Our growth at a reasonable price investment philosophy, combined with diversification between stocks and bonds, ensures your portfolio has the downside protection it needs. And frankly, it allows us to capitalize on volatility, not run from it. Our commitment is to navigate all market conditions by managing our investment platform and your portfolio with discipline. 2025 will be another year to do the same, regardless of how strong political winds may blow.